Inexpensive home shelters offer the best shielding between you and the radiation. Very simply, a fallout shelter could save your life in a nuclear war. This is the reason the Office of Civil and Defense Mobilization strongly urges that every family build a shelter in its home.
Let's face it, we all want to be prepared when disaster strikes, but the question becomes, can you really build a financial bomb shelter? Some say that's exactly what safe haven investments are meant to be. But what qualifies as a safe haven investment, and just how safe are they in today's uncertain economic environment? Yeah, it's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. As you may already know, a safe haven investment is one that's expected to retain or possibly even increase in value during times of market turbulence. Its main purpose is to limit your exposure to losses in the event of a market downturn. Now, if that sounds familiar, it probably means that you're a regular viewer of the income generation. We talk a lot on this show about the importance of protecting your money from market volatility, although we don't often use the term safe haven. And that's partly because I believe the term is inaccurate and possibly misleading. While yes, there are strategies that can significantly reduce your financial risk, there's really no such thing as a so-called safe haven investment. It's what I call fact based upon fiction, and we'll talk a lot more about that later on in today's show. We'll also answer some important questions about assets usually considered to be safe havens, and we'll discuss the real key to protecting and growing your money in today's economy. Joining us today are Brodrick and David Stearns. But first, let's talk about exactly what constitutes a safe haven investment. As prices for Bitcoin and other cryptocurrencies soared last year, debates emerged about their future potential as safe haven assets. Other types of currencies are already considered safe havens, along with things like gold, other precious metals, industrial and agricultural commodities, real estate, consistent dividend, aka defensive stocks, and of course, U.S. Treasuries and other government and investment-grade bonds, which are part of what I like to call the universe of income-generating financial alternatives. But what exactly does it take to qualify as a safe haven asset? The investment research and management company Morningstar recently created a framework for gauging whether a specific asset might qualify as a so-called safe haven. The first test is whether it meets the general definition, which again is an asset that holds or is designed to increase its value in periods of economic uncertainty and market downturn. It should also be an asset, ideally, that preserves capital, withstands volatility, and provides diversification in an investment portfolio. But what else? Well, according to Morningstar's framework, liquidity should also be considered. Can the investor convert his or her asset to cash easily? Currency is obviously the most liquid asset. By contrast, though, real estate transactions can take months to complete. So, while real estate may fit the framework for safe haven assets in other areas and other parts of the definition, it doesn't fit so well in terms of liquidity. Of course, with certain safe haven assets, sacrificing some liquidity is actually part of the point. That's true, for example, with strategies designed to protect principal while generating interest and dividends, namely things like government bonds and investment-grade corporate bonds and bond-like instruments. The reliable income stream is what actually replaces the need for liquidity. And the reality is that most retirees don't need nearly as much liquidity as they may think. Another criterion identified by Morningstar for safe haven assets is something called functional purpose. In other words, does the asset have a purpose beyond its arbitrary value? Obviously, real estate meets this criterion well because it can be developed into new asset-like businesses. Additional uses theoretically create an anchor of demand for a particular asset and help provide long-term stability. Commodities like oil, gas, wheat, those things also fit into this area of framework well because they can be processed into higher value goods. Typically, they have a strong functional purpose and therefore a strong anchor of demand. Another factor is scarcity of supply. That's important because scarcity often can help create value. The more rare something is, the more valuable it often becomes. For an asset to qualify as a safe haven, investors need some assurance that its supply growth won't outpace its demand growth. When that happens, the asset's value can erode even if demand is growing. And this can ultimately lead to long-term price deflation. That's basically how an asset becomes, quote, a dime a dozen. Real estate and commodities both hit the safe haven framework well in terms of scarcity. Why? Because there's only a limited quantity of assets in each of these classes. Now, if you're a regular viewer, you've probably heard me discuss the Federal Reserve's ongoing efforts to drive up long-term interest rates. How? By selling back trillions of dollars of bonds and bond-like instruments in the U.S. market. These are bonds that it actually purchased as part of its quantitative easing efforts. The idea here relates to scarcity, since they're trying to cause supply to outweigh demand to such a degree that bond values drop. So far, this effort hasn't been as successful as the Federal Reserve would like. Again, something we'll talk about more in just a bit. Another factor to consider in assessing safe haven assets is future demand uncertainty. In other words, will there continue to be a demand for the asset in the future? And what are the chances that something new might come along and diminish its future value? No one really has a crystal ball, but the future demand for some assets is more certain than it is for others. Real estate, for example, once again, is an asset whose future demand can be counted on fairly well, while some commodities are a bit more of a gamble. Consider coal, for example, whose demand has dropped sharply as alternative energy sources have emerged, and it's actually diminished coal's functional purchase. Finally, a so-called safe haven asset should have a degree of permanence, a certainty that it won't deteriorate over time and lose its value. Obviously, this applies mainly to physical assets more than it does to market investments like stocks and bonds. So, within this particular framework, the question becomes, which safe haven assets are the most popular, which are the most reliable, and what are some of the important details you need to consider before investing in a so-called safe haven? I'll get into all those questions and more in just a bit. But right now, it's time to welcome our first guest, Sean Brodrick. Sean Brodrick is an investment strategist for Weiss Group. He travels far and wide seeking out values in the natural resources sector. A graduate of the University of Maine, he has more than 25 years of experience as a professional journalist and a financial analyst. He's a regular contributor to Dow Jones Market Watch, and he shares his insights and expertise frequently in the financial media. He's the ultimate author of The Ultimate Suburban Survivalist Guide. Sean, welcome back to the show.
Thanks for having me back.
You know my philosophy. You know each other well enough that you know that I'm a little skeptical about some of these so-called safe havens. There's no true safe haven. In reality, everybody thinks treasury bonds are, but let's face it, even the U.S. government can default on its debt, right?
Let's hope not, but it is possible.
Yeah, let's hope not, but it's possible. So of all the safe havens, which would you say are probably the ones that our viewers or income generation members should know about first?
Right. My experience has taught me that the real safe havens have to be precious metals, silver and gold. I mean, those are the ones that I've been working in for years, and they hold their value over time. They're the ultimate safe haven. When people are worried, that's where they go.
Okay. Now, some precious metals, I know have an ultimate demand. Copper, there's a need for copper.
Silver is very industrial.
Even silver is becoming more industrial. Mm-hmm. The one that's always gotten me is gold. You know, in a good economy, sure, there's always a demand for gold in the forms of jewelry and luxury items. But in the case of economic bust, that demand goes down. And last time I checked, no one's been able to get nutritional value into gold or being able to melt it down so you could turn it into food or turn it into shelter. So help me understand how gold really fits into this conversation of safe havens in the real world.
Right. Well, in the real world, you can't print gold, but you can print all kinds of other money. And there have been entire political movements based around the fact that, gold is money. It's something that the government can't mess with, and we know the government likes to mess with financial things.
Even though we haven't been on the gold standard in over 40 years.
No, we haven't. And in fact, the last time someone tried to put us on the gold standard, that was Andrew Jackson, it caused a depression. So it's not like, now there are people who insist that we should be on it. I think that gold is a definite part of a safe money policy.
But it sounds like it's more of a safe money policy, not because there's an underlying demand for gold per se, because most of the world now is based upon fiat currencies.
Yes.
But it is because of people's perceptions. So when the economy turns south, people buy gold as a perceived safe haven. You think more of it's perception than maybe reality?
Well, I think 95% of the market is perception. And
True.
Speaking of that, we saw a recent market downturn that began in September, and it's funny what bottomed in September was gold, because as people got afraid, what did they run for? They ran for gold. They didn't run for cryptos. They didn't run for other things. Gold is the ultimate safe harbor, and they know it.
So gold had bottomed out when the market was at its peak, and then as soon as the market started to fall, you're saying gold value started to come back up again.
Right, and then the miners that are leveraged to gold, those are the tickets on the rocket. Those are the things that are really taking off. Even though we've seen some terrible days in the market recently, gold miners, the good ones anyway, have been going higher.
So I want to talk to you about that when we get back from the break, because the reality of it is most people can't really afford to go ahead and buy gold bullion per se and insure it and store it, and they don't want to. It's too much of a headache. So I know there are some other ways to invest in gold more indirectly, and after the break I'd like to pick your brains about that if I can.
I would love to talk about it.
All right, sounds great. Stay with us. We'll be back with more from Mr. Brodrick, and we'll be back with more here on the Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
For some investors, gold is, well, gold when it comes to safe haven investments. Historically, when adverse economic conditions arise that forecasters say could last a while, demand for gold rises, driving up the value. And as the threat of rising inflation occurs, the value of gold also tends to increase. Why? Because gold is priced primarily in US dollars. Thus, gold is typically considered a solid long-term investment and a safe haven against economic downturns and inflation. Gold is among one of the most popular safe haven investments in the commodities asset class. Unlike money, the value of gold and other commodities aren't directly impacted by interest rate decisions that are made by central banks. Like gold, other commodities such as silver, copper, sugar, oil, corn, livestock also do not typically trade in tandem with the equity in the bond markets. That's another reason they're often classified as safe havens for investors. Now that all sounds great, but please keep 2 things in mind. First, remember that overall, the commodities markets can be volatile, and investments in commodities typically don't come with contractual guarantees, unlike, for example, government bonds. They're considered safe havens based mainly on that one item in the framework we discussed, future demand certainty. But the reality is they're not that different from general stocks in terms of their risk potential, as you'll see a bit later in the show. And here's one more thing to keep in mind about so-called safe haven investments in general. The real key to protecting your portfolio from market turmoil and other risks lies not simply in the assets you choose, but in the strategy that you devise based upon your specific goals and your situation. So, with those facts in mind, let's look at some other types of assets that are commonly considered safe havens. One I mentioned earlier was consistent dividend stocks, also known as defensive stocks. Defensive stock is theoretically something that should provide consistent dividends, no matter the state of the overall stock market. Even though they are considered a defensive stock, keep in mind that it is a stock, and therefore there's potential for loss of principal, as with all stocks. But the dividends tend to soften the blow a bit in terms of market turmoil. There are certain products that consumers are sure to keep buying no matter what. Things like food, healthcare products, and basic home supplies. These are necessities that people will continue to pay for regardless of how poorly the economy might be doing. Therefore, the stocks of utility companies, healthcare companies, biotechs, and consumer goods companies are some of those that are considered to be defensive industries. Why? Because their products have future demand certainty. But here again, even though companies operating in defensive sectors tend to attempt to retain their value, or I should say retain their value a little bit better than others in times of market uncertainty, these markets, like commodities, can still be highly volatile. And since investments in defensive stocks typically aren't contract-based, like bonds, for example, they carry the risk of loss of principal. One so-called safe haven investment that's different in that respect are some specific classes of preferred shares of stock, or we often call them by short, preferreds. Preferred stockholders receive a fixed dividend, and therefore they also have a greater claim to a company's assets and earnings than common stockholders. And this preferred status is actually a very important thing to have during an economic downturn. Why? Because if a company must liquidate its assets and pay creditors, they're contractually obligated to pay back preferred stockholders before common stockholders get any of their money returned. Preferred stock is sometimes referred to as a hybrid security because it has bond-like characteristics. Like bonds, preferreds are designed to provide income at a fixed rate and also have a par value, therefore have a little bit more protection against loss of principal should the stock market drop. Certain foreign currencies, in particular the Swiss franc, are another type of investment often considered to be a safe haven. Given the stability of the Swiss government and its financial system, the Swiss franc usually experiences increased foreign demand during times of economic uncertainty. And then there's plain old cash and cash alternatives, which some see as safe havens against market downturns. While cash alone certainly offers plenty of liquidity, it also offers no return, or very, very little. And its value will actually diminish over time due to inflation. And in this current economic environment, cash alternatives such as savings accounts, money markets, and CDs really aren't doing much better than plain old cash. Yes, your investment accumulates interest. But even after the latest hike in interest rates, just last month, the current federal funds rate is still only 2.25%, which makes it below the current inflation rate of almost 3%. So while cash and cash alternatives may be safe from the effects of a major market loss and they could offer some liquidity, they're probably not the most viable part of a strategy designed to have your money working for you. What does that mean? It means that not only safe, but growing and generating reliable income at a reasonable and competitive rate of interest or competitive rate of dividend. Coming up, we'll talk more about some of these traditional safe haven assets and how they're faring in our new unprecedented age of economic uncertainty. We'll also talk much more about how to really keep your money safe in this uncertain age by applying strategy, not necessarily by relying on so-called safe havens. But now it's time to welcome back Sean Brodrick. So Sean, right before the break, I promised our viewers that we'd talk a little bit about how the average person can invest indirectly in gold, if you will, and have it be much easier than trying to store and insure gold bullion. Tell us about some of that, please.
Sure. Well, you can always purchase gold through an ETF, which is what many of the big investors on Wall Street do. You know, I mean, one thing that I actually favor more than buying physical gold, though I own plenty of physical gold, is I like to buy those select miners that are well leveraged to the price of gold. So when the price of gold goes up, their profit margins really widen. And so those companies can really start to look very attractive. And we're at a fascinating time for gold companies right now. And this is one thing that I have to mention, which is that right now, there are basically two ways for any gold miner to get more ounces of gold, because gold is a depleting asset. As you take it out of the ground, you have to replace it. One is to head out and explore for it. The other is to buy other companies that have gold ounces in the ground. Okay. It's now cheaper for companies to get those ounces through purchasing other companies than by exploring for it. And that's an unusual situation in the market that's usually resolved by higher prices, because it's really not worth anyone's time to go look for gold.
Interesting, quite interesting. Mergers and acquisitions. So, okay, so gold aside, I know you like silver. What else in the commodities market do you like?
Well, I like a metal that it's really hard for people to actually trade, but there are miners that are looking into it, and that's lithium, because of the electric vehicle revolution, and copper is also going to be a huge part of that story. So you look at those things, they look excellent. One last thing that I have to mention, which no one covers, and it's hated more than gold, it's uranium. That is on the brink of a bull market like you've never seen. And if the money going into the gold market goes through, say, a small tube, the money going into uranium has to go through a flavor straw. There's only about 40 companies you can trade in North America, and most of them are like explorers with cow pastures. So the profit potential there. Now, this is not, this is not income generation.
Sure. None of it is, but that's okay.
Right. So it's not what you would really do, but for a small portion of your portfolio, it
could work.
You can really, really do well.
Uranium, I think that's actually taken from Uranus. Isn't it the planet Uranus? No? I don't know. Maybe not. We'll be right back.
David J Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
You've heard me talk a lot in this show about our new unprecedented age of economic uncertainty. The loose monetary policies and short-sighted artificial stimulus efforts, these that were undertaken by our own Federal Reserve as well as other central banks around the world, have fueled this uncertainty and continue to do so. This global economic experiment has created an overinflated stock market more dependent on artificial influences than economic realities. It's also created an environment in which overall low interest rates may just be the new normal, and where even there, so-called safe haven asset classes have also experienced new levels of uncertainty. Earlier this year, the Wall Street Journal looked at how safe haven markets were moving in, quote, strange ways amid the record levels of volatility that rocked Wall Street in the first quarter. For example, gold, the Swiss franc, U.S. Treasuries, all fell in the wake of the market's 10% correction in early February. Under normal circumstances, those investments typically rally in response to a dramatic market drop, as investors have a flight to quality as they flee to safe havens, driving up demand, diminishing supply, and thus increasing value. As the Journal put it, this was, quote, the latest sign that financial markets may be navigating uncharted territory as years of central bank stimulus start to wind down while volatility returns and borrowing costs rise, close quote. With new levels of uncertainty impacting even assets traditionally seen as safe havens, many investors and analysts are now asking the same question. What is still actually safe? Well, let's face it, no investment is entirely risk-free. As I've already discussed, I believe the very term safe haven is dubious and misleading in many ways. But do some so-called safe haven investments carry new or increased risks of volatility and loss in this new age of economic uncertainty? Though it's probably too early to answer that question with any certainty. We might get an idea by taking a quick look at how some other popular safe haven investments have been faring so far this year. For example, in the first half of the year, commodities returns failed to live up with some bullish expectations, thanks largely to yet another new element of uncertainty recently introduced into the economic picture, and that is the president's trade policies. As market analyst Adam Coos put it, performance this year has been a combination of fundamental strength and geopolitical hindrance. Trade news has dominated commodity prices, and there is so much uncertainty. As for gold, it's down about 8% from its 2018 high. Now, most agree that the biggest reason for the slump is the renewed strength in the U.S. dollar, which recently climbed to levels not seen since June of last year. That means a dollar-denominated ounce of gold has become increasingly expensive for non-U.S. investors, which has forced them to scale down their demand for the precious metal, and again, decreased demand equals decreased value. As for real estate, you probably already heard that the U.S. housing market is currently in the midst of a slowdown that some analysts predict could have some pretty serious implications for the economy overall if it doesn't turn around by next year. The Economic Cycle Research Institute recently reported that its leading home price index has taken a downturn not seen since 2009 during the tail end of the Great Recession. And while the S&P 500's Case-Shiller Home Price Index isn't yet in negative territory, it seems to be decelerating also. Some analysts have characterized this as a flashing yellow light for the overall economy and a flashing red light for the housing and real estate markets. And it's no secret that the bond market has been broadly impacted in this new age of economic uncertainty. I've already mentioned the Fed's efforts to drive up long-term interest rates with the so-called unwinding of quantitative easing, again by flooding the markets with U.S. Treasuries. That effort has proven to have its limitations so far, and I believe those limitations might just continue. Now, that can be good news for some safe haven investors, some of those asset classes best suited for income-based financial strategies, such as investment-grade bonds and bond-like instruments. Why? Because bond values and interest rates, as most people know, have an inverse relationship. But even in the unlikely effort that the Fed's efforts and other factors do manage to force long-term rates up near that 4% market or so, that level, I believe that investment-grade bonds and bond-like instruments will continue to remain a viable alternative for investors focused not simply on an asset class, but on actively managed strategies designed to protect principal and to generate income. And we'll talk more about that a little bit later in the show. But now it's time to welcome back Sean Brodrick. So Sean, now that we talked about the safe havens, if you will, that you tend to favor, tell us about a couple of safe havens that you hear about a lot today that you think are maybe more suspect.
Well, I have to tell you, I work with some very smart people over at Weiss Group who think that bonds are going into a bear market. And so if you listen to those guys, they are saying get out of bonds right now. So I have bonds in my own portfolio, but I plan on holding them until I retire, so I'm not that worried about it. But for people who actually watch that market, that's one you should actually be very careful of, probably.
Yeah, people say, bonds, but if they look at a total return strategy and you're trying to trade them, and look at total return from day to day, that's one thing. But like you said, If you buy a bond, you still have a guaranteed interest rate for the life of the bond. When it matures, you get your guaranteed repayment of principal back. So if you hold them to retirement, you still know what you have.
Exactly, exactly.
And one of the things that nobody talks about with bonds that always amazes me is the credit spreads. A lot of people tend to ignore, and I know with your company it's a little different because a lot of people like to talk more about the riskier assets, talk more about the stocks and the commodities and so on, not so much the fixed income. But people who are in the fixed income markets per se, like we are, tend to realize that the credit spreads often tend to have an expanding and contracting element that oftentimes offset a lot of the risks of rising interest rates. So whereas if you were in government bonds and rates go up, you could take a shellacking. If you have the right level of credit spreads factored in, it could be a real softening effect.
Well, right now the real factor we are seeing in the credit markets is we're seeing U.S. interest rates go higher. And so that's actually one of the things driving the stock market lower. It's all a big scary thing, which brings us back to the thing we were originally talking about, safe havens. When people get scared, they run for gold. So people should keep that in mind. Okay.
So in 45 seconds or less, cryptocurrencies. I'm really suspect of that. I fear sometimes they could be, the next tulip mania, if you will. What are your personal thoughts?
Well, I can tell you Weiss Group has an entire division focused on how to make money from cryptocurrencies, but I'm not in that division.
So you can make money trading them, but
yes,
what are your
exactly.
personal thoughts long term? Will a cryptocurrency end up being the world's currency, or are you, like me, skeptical that long term that'll happen? Forget about short term trading opportunities.
Right. Longer term, anything can happen and probably will. The winning cryptocurrency may not have been invented yet, which will be the weirdest, scariest thing when that finally comes around. Personally, I love hard assets. I love silver. I love gold. I'm an old curmudgeon, and those are the things that are interesting.
And if there's other people like you that think like that, it's very possible that none of the cryptocurrencies end up being the safe haven. So go ahead and tell our Income Generation members how they can find you or read about you.
Sure. I have free columns that run 3 times a week, and that's at edelsoninstitute.com.
Thank you so much for being on the show. I appreciate
Thanks.
you being back.
I had a great time.
Stay with us. We'll be right back here on the Income Generation. I'm David Scranton.
Visit the Retirement Income Store at soundincomestrategies.com today to receive your free digital income kit. The digital income kit includes free reports, whiteboard animations, and an educational DVD, all packed with easy-to-understand information on how actively managed income-based investment strategies can help you achieve your retirement goals. Go to soundincomestrategies.com right now and click on the Income Kit tab to request your digital income kit absolutely free. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Recently, we aired an episode of The Income Generation that explained the origins of not just this show, but the entire investing for income revolution among baby boomers. Basically, that revolution started in the wake of the 2000 and 2002 stock market crash, which left many Americans financially devastated and also convinced that there just had to be a better and more conservative way to save and invest for retirement. The truth is, there always was. Bonds and bond-like instruments designed for safety and income were actually very popular with everyday investors in the 50s, 60s, and even into the 70s. That all changed in the 1980s and 90s during the best long-term secular bear market this country has ever seen. The stock market went 18 years with only really one correction, from which it quickly recovered. As a result, many investors, as well as financial advisors, became addicted to the stock market, and some haven't managed to break that addiction even to this day. But some of the more visionary advisors, the ones who recognize that this 2000 to 2002 crash was merely the start of a new long-term period of volatility and increased risk for the stock market, actually broke the addiction and made a change in their business model. Ever since, we've been working to educate investors about why bonds and bond-like instruments can be a reliable alternative for investors seeking safety, oftentimes regardless of market conditions. But not just because of the assets themselves, it's because they can serve as the basis of a diversified financial strategy. They can be actively managed to ensure protection and to generate income at competitive rates, even in an environment of overall rising interest rates. And that means protection not just from market losses, but from many of the other influences that can undermine or sabotage your retirement goals, including things like inflation, taxation, healthcare expenses, and the danger of spending down principal during retirement. While many baby boomers broke their stock market addiction after that first market crash in 2000, others didn't come around until after the 2000 to 2009 market crash. My hope is that it doesn't take the next major correction to convince other investors over the age of 50 how important it is to shift their focus away from riskier investment vehicles, away from growth, toward income, toward alternative options focused not just on safety, but income and therefore strategic portfolio growth. Again, I believe a true safe haven isn't just an asset class, it's an actively managed strategic approach, an approach that's designed with the help of an advisor who specializes in income-generating investment alternatives. Now, let's welcome our next guest, Dave Stearns. David Stearns is a well-known financial advisor as well as a very, very good friend of mine from the area of Atlanta, Georgia. David, it's great to have you back on the show. Welcome.
Thank you. Good to be here, Dave.
So as you know, you heard a little bit of our show earlier. We're talking about safe havens and the like. And you're in the saddle every day. You're sitting there talking to clients every day and so on and so forth. What's their general vibe today about the markets, about interest rates? What are people feeling? What are people's concerns that you're hearing grassroots, not the talking heads on TV, but grassroots?
Sure. Well, as you know, the Stearns Retirement Group, a lot of the folks that I meet with are very near retirement, right, or some of them are deep in their retirement. And while they've enjoyed this great uptick of the market for a number of years, many of them don't know how to deal with a lot of the uncertainty, especially in retirement. That makes them very uncomfortable. There's a lot of interest rate uncertainty, just a lot of investor uncertainty. So the general feeling is that they're concerned and they're looking for better places for their money at this stage in retirement.
Now, Wall Street will say, hey, if you've got enough money and you retire, then you can afford to take the loss. And that's okay because you have enough assets. But when I talk to clients, I don't find that that's the whole truth. Because even if you have enough money where you can afford on paper to take a loss during retirement, the reality of it is it affects people emotionally. It detracts from their enjoyment of retirement. Have you found this to be true also?
Well, it does. I've been doing this for a long time, and I've worked with retirees that went through the drop in 2000, again the drop in 2007, and maybe they had a lot of money, but it's a whole different ball game when you're accumulating money and you lose money on the way up than when you're decumulating money, taking income, and the markets are falling. It's a different feeling altogether. Sometimes we talk about the wealth effect. They just don't feel wealthy. Yeah, they might still have $1 million, but if they lost $400,000 or $500,000, it changes their attitude on retirement completely. They won't spend money, and they're and it's not the way that they wanted to enjoy retirement. So that's the part I think Wall Street often misses, because Wall Street doesn't often look into the eyeballs like I do every day of investors, real people.
Yeah,
tired.
They tend to lose the human factor, and it's true. You pick the net worth. It could be $500,000, could be $1 million, whatever the net worth is. When you're passing it on the way up, you're feeling good. When you're passing it on the way down, not so good. David, stay with us. We'll be back for one more segment. And you stay with us too. We'll be back with more here on the Income Generation. I'm David Scranton. David, welcome back to the show.
Thank you.
So you heard our previous guest talk a little bit about a possible pending bond bubble, right? And of course, you and I laugh at it when we hear people say that. And of course, as you know, his specialty in his firm is really commodities. And when he was talking about a bond bubble, he was listening to the stock market experts at his firm, whom, as you know, stock market experts love to talk about a bond bubble because they really want you to be in the stock market, not the bond market. But you know, David, your clients, my clients, hear the same stuff when they turn on the television, as our viewers just saw a few minutes ago. And at the end of the day, they look for safe havens, not income generating safe havens. They look like things like gold and Bitcoin and things that they think are safe havens per se, and which could be, but don't generate income. What is it they're really looking for? Why is it you think they're focusing on those types of things?
Are you saying why are they talking about a bond bubble, or why are retirees looking for the safe havens?
Why retirees are looking for those other types of safe havens outside of the income generating world versus looking within the income generating world?
You know, Dave, probably because our industry has done a tremendous job of shaping so many of the minds of the average investor. And so they're looking for something exciting. They're looking for something more exciting than the bond market. The bond market will probably clear a cocktail party when you think about it. But the reality is the bond market is nearly twice as big as the stock market and has provided a great deal of income and stability for generations of investors. But that's not nearly as exciting as gold and Bitcoin.
Now, how much you hear today the trade wars as being an impetus for people coming to you saying, where can I put my money that's safe?
Well, certainly, you know, the media has done a good job of scaring people with the trade wars. Sure. And so people have that as a big concern. But, you know, Dave, I think what the president has done, in my mind, there's been a lot of method to his madness, meaning, you know, he started a huge bonfire. That would be the U.S. economy by giving one of the best corporate tax cuts we've ever seen. In the first quarter of this year, you know, it generated $117.4 billion in corporate tax savings, and those dollars have been spent. And we can see that investors have benefited through higher dividends. And so and then he's throwing cold water on a bonfire, the bonfire being the U.S. economy, the cold water being the trade wars. And so at the end of the day, I think I'm able to help my clients realize that the trade wars, yeah, they may be uncertain and a little bit scary, but those isn't probably going to be what triggers what we're seeing right now in the stock market. So those fears should be centered a little bit more around interest rate uncertainty, rising inflation, those types of things, not necessarily the trade war.
But it's interesting, even in a pretty politically conservative part of the country like the one in which you live, people still buy into all that media hype about, oh my goodness, the trade war, the trade war. So, David, I hope to have you back sometime. We have to leave it there for today. Thanks for being with us. Stay with us. We'll be right back here on The Income Generation. I'd like to thank both of our guests for joining us today for another episode of The Income Generation. Of course, I'd also like to thank you, our new and returning viewers. If any of you are runners or athletes in any sport, you know that after a certain age, you have to change your approach to the game. I have clients in their 60s and 70s who are still running marathons, but not only have their goals for the race changed, but so have their strategies. They're no longer concerned about just winning per se. They want to finish with a time that they can be proud of, knowing they've used the right strategy to achieve that goal. I mention all this because I believe the very notion of a so-called safe haven investment to protect your retirement savings isn't much different from the idea of a power drink or running shoe designed to help you win a marathon. You can try it if you'd like, and it might even help you a bit. But if you aren't doing everything else right, if you aren't focused on the right goals and using a strategy that's right for you and your goals, the shoes or the power drink simply won't help very much at all. By the same token, you can invest in gold or commodities or some other so-called safe haven asset class and believe that that alone is enough to protect your savings and ensure you'll have the income you need to enjoy retirement. Or you can work with the right advisor, an advisor who can help you create a strategy designed to really protect your portfolio and to generate reliable income that you need to meet your retirement goals, and to grow your portfolio organically through strategic reinvestment. Again, when it comes to protecting your money, which should be one of your main financial goals after the age of 50. It isn't about so-called safe havens per se. That whole idea is, again, oftentimes fact based upon fiction. Instead, it's about having the right strategy, meaning one specifically geared toward protection and income. And that's a fact based upon fact. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Visit the Retirement Income Store at soundincomestrategies.com today to receive your free digital income kit. The digital income kit includes free reports, whiteboard animations, and an educational DVD, all packed with easy-to-understand information on how actively managed income-based investment strategies can help you achieve your retirement goals. Go to soundincomestrategies.com right now and click on the Income Kit tab to request your digital income kit absolutely free.